Hi, my name's Harry. Joining with me today on the project are Groshvin, Alex, and Harry. Our investment thesis focuses on a sudden market event where a BBC investigation releases a breaking report claiming that glyphosate, the active chemical in many pesticides used in 34.9% of all herbicide sales across Europe in 2023, has been found highly carcinogenic under new scientific evidence. The discovery triggers a snap EU-wide ban, sending shockwaves through the agricultural sector, particularly within Europe. Chemical reliant firms like Bayer AG face immediate sell offs, while agricultural tech leaders such as Deere and Company benefit from a rapid shift towards non chemical precision farming solutions, as shown by the pricing forecasts. I'll now hand it over to Groshvin to explain the impact of this event in more detail.
Thanks, Harry. The announcement would trigger an immediate sell-off in companies relying on glyphosate, with Bayer being the most exposed, with the crop science division having earned 22.3 billion euros in revenue last year. In the short term, we expect volatility and large-scale sell-offs as investors reprice risk. However, in the long term, the market reallocate capital towards sustainable technology-driven agriculture. The European precision agriculture market is valued upon 3.4 billion USD last year and is projected to exceed $6 billion by 2034, reflecting strong growth. This positions Deere and Co as a clear long, as Deere has invested heavily into AI-powered precision farming and autonomous machinery, enabling farmers to cut fertilizer pesticide while maintaining yields. From an ESG perspective, Deere aligns with the European Green Deal and Farm to Fork strategy, offering environmental benefits and long-term earnings potential. Overall, this event represents disruption and opportunity. Our thesis supports a strategic rotation away from chemical-reliant producers such as Bayer and more towards sustainable innovators such as Deere and Co. With this in mind, Harry will talk about the long opportunity of Deere and Co.
The European Union's decision to suddenly restrict pesticide use marks a significant disruption for global agriculture and presents a unique opportunity for Deere and Co. As stricter regulations compel farmers to adopt new practices, demand will increase for equipment that enhances efficiency under these constraints. Deere's focus on precision agriculture and autonomous machinery enables farmers to reduce their excess pesticide use. This positions Deere favorably to capitalize on the regulatory shifts and drive further growth. Our valuation supports its thesis. With Europe currently representing 17% of total sales, after the regulatory shock, it's undoubtedly going to grow. And it's shown that sales are projected to rise 47% in the first year and continue to grow strongly before stabilizing at the terminal growth rate. Using a WACC of 6.92% and the terminal growth rate of 3.5%, our DCF model estimates a fair value of $613 per share, an upside of 34% from today's market price of $457, hence our bar recommendation. Looking at these graphs, we can see that the market price currently underestimates the value of the share compared to the DCF projection. And if Deere's cost of equity declines through stronger ESG alignment and investor confidence, its WACC would fall further as well, amplifying long-term growth upside. I'll now pass it on to Alex with the sell recommendation.
Thanks, Harry. Our sell recommendation is Bayer AG. Following the European Union's snap ban on glyphosate, Bayer faces severe structural challenges that fundamentally alter its valuation. Glyphosate-based herbicides such as Roundup made by Bayer AG represented approximately 15 to 20% of Bayer's total revenue through its crop science division, and Europe accounts for over 33% of its sales. With this ban in place, Bayer faces a dramatic contraction in its agricultural revenue, with major restructuring costs in the future as they shift towards alternative products. We have remodeled Bayer's valuation to reflect these headwinds. In the best case scenario, revenue growth is expected to decline by around 5% annually between 2025 and 2027, before slowly stabilizing to a 1% growth towards 2029, and finishing with a terminal growth rate around 2% as the company hopefully shifts towards lucrative alternative products. Importantly, investors' risk perception has surged. We raised Bayer's beta from 0.99 to 1.5, capturing the heightened volatility and legal uncertainty, which lifts the WACC from 5.38% to 6.46%. This is still conservative, as there is also increased risk for creditors to see downgrade risk and widening credit spreads if cash flows deteriorate, increasing the WACC even further. Combined with slower sales growth averaging -5% from 2025 to 2027, gradually recovering to 2% by 2031, our revised DCF produces an intrinsic value of roughly $22.3 USD per share, a downside to valuation of 31%. Accordingly, we highly recommend selling Bayer AG as the glyphosate ban significantly undermines its earnings outlook, risk profile, and long-term valuation. Thank you.